Hello everyone, it's Tuesday, March 21st. Today on the Final Bar, I'll be talking with Samantha LaDuc of LaDuc Trading, talking to us about technology, which has been on a pretty significant run here recently. We're in Fed week. What does this mean today and tomorrow? What do we hear from Powell? How does that impact interest rates and all the other risk assets? Ladies and gentlemen, this is the Final Bar. Hello everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts. The StockCharts platform was created to help individual investors, financial advisors, and everyone else, all other market participants, the ability to understand the markets more deeply by focusing on the message the markets provide back to us, by analyzing trend and momentum, breadth, sentiment, and how those things are transitioning from different phases to the next can really help us understand and quantify investor sentiment. Quite a risk-on sort of feel to the day today. Usually a bit of a quiet time leading into the Fed meeting tomorrow, but today really sort of a risk-on feel with the NASDAQ pushing higher again, about 1.6%. What does this mean for the broader health of the equity space? We have a great guest today, Samantha LaDuc, to help us make sense of it. But first, let's get to the market recap and see what actually happened during the trading day today. I do want to start with a poll, by the way. We always have a poll going on our live stream page if you go to StockCharts.com. Also on our social media accounts, and we asked you recently, which indicator is a trailing stop based on average true range? 66% of you, 100% correct. Chandelier exit. This is a methodology really popularized by Dr. Alexander Elder in one of his books where he talked about the chandelier exit. It's a fantastic sort of dynamic stop based on average true range. So the wider the range, the more volatile the chart, the wider the exit, right? So you don't get whipsaws, and it really is more of a dynamic adjustment. The ADX line is based on average directional movement. It has sort of an implication about range, but it's really more meant to measure trend strength. Bollinger Bands, not really. That's actually looking at standard deviations, percent moves away from a moving average, and the DK trailing stop bands isn't a thing. I actually just made up that name. But if 19% of you say that's the right answer, it's telling me I should maybe make that. So trademarked as of this moment. I'll let you know when that one's ready to go. But chandelier exit, 100% right. And if you don't know that methodology, by the way, go to the chart school portion of our website and get familiar with it. It's a really good way to make sure you lock in gains and minimize downside risk. Let's continue on with our market recap. As I mentioned, sort of a risk-on feel to the day today. The S&P managing to close back above 4,000. It's fascinating to me as we set the stage. We are setting the table for our meal with Fed Chairman Powell tomorrow, where we hear the results of their two-day meeting and the press conference afterwards. Sort of a risk-on feel with the movement to the upside continuing. The NASDAQ composite leading the way higher, up 1.6%. Worth noting that small caps outperformed by a little bit. Mid caps were actually up almost 2% today. So it wasn't just technology today. Energy, consumer discretionary, financials, those are the top three sectors today. The VIX, by the way, continued to push back lower. So we've talked about this uncertain environment, the increase in volatility as measured by the VIX index, measured by the MOVE index, and other sort of measures of market volatility coming in, right? And this week, you're actually seeing those volatility measures come down. Still elevated by the loose definition of whether the VIX is above or below 20. So the fact that it still remains around 2150, still elevated volatility relative to historical averages, but weaker than it has been or lower than it has been in terms of volatility readings so far in the last 3 to 6 months. Looking elsewhere, the entire yield curve kind of moving up a little bit today with the 10-year yields pushing above 3.6%, long bond yields above 3.7%. Short-term yields still much higher at 4.6%. So we still have that inverted yield curve, of course, that we've been talking about for quite some time. We've also been reviewing this sort of risk-off move or a safe haven trade with bonds rallying. Again, a bit of a mean reversion to some of the trends we've been talking about in recent days, where stocks are rallying today, bonds are actually down. The dollar right in the middle, essentially flat for the day today. Looking at commodities, overall commodities stronger, but that's really more the energy portion of commodities that we're doing well. Some of the soft commodities we track are a little bit lower, like corn, gold, and silver, the precious metals down as well. Cryptocurrencies continuing to be bright green here, and it's so interesting as we've been debating sort of the bull-bear endless debate in the equity space. Cryptocurrencies just continuing to move higher as if they're not risk assets, and maybe it's something, maybe we have to change that label at some point. But Bitcoin up above 28,000, Ethereum testing 1,800, up another 3% today, and you can see others continuing to push to the upside. So overall, improvement, continued improvement in the cryptocurrency space, which is interesting because I often think of cryptocurrencies, certainly recently, as more of a proxy for speculation. Speculative pressures encouraging here at this point, with cryptocurrencies continuing to push to the upside. Let us just check in on a chart of the S&P 500, see where things are at today and what that means. And as we always like to do on this show, let's connect today's action to the bigger picture. What did we learn? How did that change the overall view or the overall perspective we've been talking about? Certainly an update today, a gap higher for the S&P. Yesterday we closed around 3950. Today we gained another 50 plus points to push the S&P above 4,000. Big round numbers always catch my eye, and the fact that we're back above 4,000 is interesting. What's more interesting is the fact that we closed above the 200-day moving average yesterday, and today we're following through to the upside. We're just below the 50-day moving average, which is currently just a couple clicks above the intraday high today. So very close to rotating above those key metrics. Also a trend line, if you connect the high from mid-February, the high from early March, pretty close to where we're at actually as of today's trading. So very close to breaking a trend line to the upside. It's interesting, you just watch these trend lines violated to the downside, to the upside, again to the upside potentially if we would go much further. You know, overall, as we think about the S&P 500, look at where we're at right now, right at 4,000 at the close. Look at where we were at in mid-November, which is at the exact same level. So it's worth noting that 1, 2, 3, 4 months of trading, it's been noise. The S&P's ranged from 3,800 up to almost 4,200. But at the end of the day, we're right at the midpoint between those two levels at 4,000. And again, that's right where we were in November. So when we talk about a market transition, talk about consolidation, and talk about how it's still an open question, which I think it is, the fact that the S&P directionally, the fact that it's just gone sideways for quite some time is pretty important. By the way, that's exactly the same level we were in mid-May of last year, which was 10 months ago. So while there have been a lot of movement sort of around that, it's worth noting that the major average is essentially flat for the last 10 months. Again, a noisy, volatile 10 months, but at the end of the day, did we gain any ground on the upside or downside? Not really. Now let's look back at what happened today, and we'll look at some of the individual charts I think that fill in the blanks a little bit more. Energy, really the story to the upside today, with the XLE, the top performing sector, up 3.5%. Second to that was consumer discretionary, the XLY up 2.8%. We have financials up 2.6%. The XLY one is actually a really interesting one because the ratio of consumer discretionary to consumer staples has been one of the least encouraging charts that I've seen. That ratio has been trending downwards as consumer discretionary has been underperforming staples. As you know, that's one of those ratios we like to follow, call it the offense versus defense ratio. Are people rotating, or investors rotating more into things you want or more into things you need? And it's a basic gauge of risk on versus risk off. It has been very much in a risk off direction, trending downwards over the last 6 weeks. Today, again, a bit of a mean reversion with XLY outperforming the XLP. Financials are number 3, also up 2.5%. The only sectors that were down today, 3 of them, and fairly defensive ones. Utilities were down 2%, real estate just over 0.5%, and then staples essentially flat for the day. Let's dig into financials a little bit because I think that's an interesting one. When you think about the XLF up 2.5% on the surface, that seems pretty encouraging, right? It's one of the top performing sectors of the day. But let's just have a dose of reality and think about what this means, right? The rally on financials is coming off of an incredibly beaten down level. So when you see FRC up 20, 30, 40%, let's remember that it still has to make up however many percent just to get back to where it started before that waterfall decline, right? So percentages can be a little bit misleading if you look at them in a vacuum. That's why the charts can be so helpful, because it shows you not just the fact that the KBE, which is the bank ETF we follow, not just that was up 5+%. That's not a bad thing. I mean, that's certainly encouraging. But remember, we have a long way to go before we get back to the levels we were just a couple weeks ago, right? So that gain would have to be compounded many, many times over to recover all the way. What's interesting, though, when I'm looking at the chart of the KBE, and we'll look at the regional banks here in a second, is the fact that they had all been oversold, and in a pretty significant way. The RSI on the banking ETF almost got down to 10, which is an incredibly low level in terms of price momentum. It shows you how significant this sell-off really was. Truly a falling knife kind of scenario. So we've bounced off of there. The KBE is no longer oversold. The KRE, which is the regional bank ETF, also coming out of that oversold region as well. So two things that I would tell you are my initial takeaways. Number one, what that tells you is we're certainly in a counter trend bounce. If I was a bottom fishing sort of trader, would I bet on a mean reversion move from here even a little further? Potentially. I don't know if I would take that trade actively going into a Fed day, because I would say that's a noisy, uncertain period. However, from a technical perspective, it makes sense that we could expect and should expect some mean reversion. Here's the thing though. What is it really telling you? How much has the overall picture changed? And that's where, again, with my guest today, I love connecting what we're seeing on the charts with really more of the macro themes, right? What would it take? What would that mean? I mean, is it reasonable to expect that banks should recover all the way back? Have we really put all the band-aids on we need to recover from a couple of banks failing? I don't know if I would be able to, if I would feel comfortable saying that. So counter trend move for sure. Could this be a counter trend bounce before the next leg lower? That is also true. And that's why it can be a bit of a concerning pattern for something like the KBE and the KRE. Just one final chart before we finish up our market recap. I did want to point out the bullish percent index did just get back above 30 today. This is one of those indicators we like to track. It's a measure of price momentum, and it really shows you, based on point and figure charts, and it shows you when we have an extreme breadth reading, and then we sort of return out of that extreme reading. If you look at these red shaded areas, which we just exited today, look back in October of last year, in June of last year, and in May of last year. Those are the other three times in the last 2 years where we've gone below 30% and then right back above. If you look at what has happened to the market soon after, we've been in a rally. Now, some of these have been more extended rallies, like October of last year. Others have been brief counter trend rallies, and I think that's the risk for this current environment. Could it be a counter trend move before further deterioration? Unknown, but for now, watch that chart and see if it continues to improve. Let's take a quick commercial break. We'll be back with today's guest, Samantha LaDuc. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. It's so great to have you join us every weekday after the close. We're proud to come to you from our new studio here in Redmond, Washington. Lots of great improvements we're going to make, and excited to make this space sing for you on the Final Bar and other shows on StockCharts TV. So much more to come. Couple quick announcements before we bring on today's guest, Samantha LaDuc. First off, we welcome your questions. I'm going to be out the rest of this week, but my friend Julius DeKempener is going to be hosting the show the remainder of this week. He would love to answer your questions live on Friday's show. I'll be back on Monday. I'd love to hear from you as well. The Final Bar at StockCharts.com. That's our email. We're on Twitter at FinalBarSCTV, and we have a fantastic YouTube channel. You should subscribe to that one and put in a question on the video you're watching as well. We'll hope to answer your question live on the air Friday show of this week. Also, to let you know about the upcoming schedule, as I mentioned, I am off with my family. We are literally going to Disneyland tomorrow morning for a couple days, and Julius DeKempener will be guest hosting the show remotely from Amsterdam. He has two really good guests to share with you. Tomorrow, on Wednesday the 22nd, Bob Lang from Explosive Options. On Thursday, Adrian Zadunchik, founder of the Bird Nest, cryptocurrency expert. Fascinating to hear from Adrian how he makes sense of the fact that cryptocurrencies are rallying in a time when arguably maybe they shouldn't be. Let's continue on our show with our guest today, Samantha LaDuc. Samantha's been a guest on the show a number of times. She's the founder of LaDuc Trading, always does such a great job of helping us make sense in uncertain times. Samantha, how are you? Welcome back.
Oh, I'm excited to be here. Hello, thank you.
It's good to see you. I really appreciate you coming in Fed Week. A lot of question marks, of course, and I feel like the picture has changed so much just in the last 5 to 10 trading days. We're starting with your charts, and the general theme we're going to talk about is just technology. Technology has been an incredible gainer over the last 6 weeks for sure. What do you make sense? Help us make sense of this outperformance of the technology space.
Well, first and foremost, we had major central bank intervention come in and the October lows. So this was coordinated. It included Treasury, Fed, Bank of Japan, Swiss National Bank, and PBOC, so China. And it amounted to over $1 trillion. And it actually started in late September and then picked up speed. And this is the gilt crash as well. Bank of Japan widening their yield curve, dollar swaps, yen interventions of great size. So this was a coordinated effort that really brought the markets to stabilization and then higher. In fact, I had literally posted the day before on October 20th, brace for impact if bulls don't defend here. And the next day, the Bank of Japan came in with a massive yen intervention. So we did have a little dip in December, but we got that January effect in full effect from the 5th right up until February 2nd. That was when we started to kind of peter out. You could see it with breadth indicators starting to roll over, especially on the 17th of February. Net selling started to pick up, and then the market started to roll over. So I loved your breadth indicator, for example, because I follow that across all the indices and lots of sectors, and I'm crazy for measuring the strength or weakness of not only the market, but also of given sectors using breadth, and it clearly started to fall very, very strongly in that February high, right into the most recent central bank intervention to stem the bank run. So that literally picked up on Sunday, March 12th. Basically, this was a coordinated effort by Treasury, Fed, and White House to stem the contagion of bank risk failures. And this was alphabet soup again, right? They came up with the BTFP, and then the open discount window they already had in place, and they pulled out a depression era banking policy to also allow banks to access. So again, this deposit run would stop, and they could start to repair the damage in the banking sector. So it has definitely helped basically put wind in the sails of the tech bulls, because it's clearly looser monetary policy, and tech, Bitcoin, and gold love looser monetary policy.
It's certainly been that, and I love how you describe it as just the central bank intervention. We've seen the ripple effects, and again, my concern is always the unintended consequences we'll be unpacking down the road, right, months and months from now. Starting with your monthly chart of the NASDAQ versus the S&P, can you help us put a little context behind this run that we've seen in tech here recently?
Okay, so first we got to go back before we go forward. I showed you this chart back in fall of 2021, and it had an SH and then an S question mark.
The question mark is no longer there, Samantha.
The question mark is no longer there. So this was a head and shoulders, basically, on my ratio analysis. I love intermarket analysis. So this was forming what I believed was going to be a head and shoulders rollover, and my other call right here, early January of 2022, was that the 13-year run in NASDAQ outperformance would end. And my bid for that particular show, which was the New Year's special, was that the markets would fall 20%, and we were at 4,800 at the time, SPX, and my price target was 3,800. I was the only one bearish, and that came true. So it was because, in large part, there are fundamental reasons and some other charts, but it was in large part this underperformance in both tech and bonds. So that was, I doubled down. I also said that bonds were going to be collateral damage with this sticky inflation, especially in wage demand growth. So long story short, you can see from this monthly, and again, I run a live trading room, so it's chase swing trend, but the point is this is swimming with the current, right? So if we were going to be coming down in NASDAQ and everyone was so excited to buy the dip, I'm like, no. You can see where we actually got a little bounce on that trend line, the monthly trend line, okay, exactly. And then we failed miserably into that October low. It's critical. That was central bank intervention. And I'm a macro to micro analyst, educator, and trader. That's what I look for the trend, for the inflection points. So I am of the belief that we are going to run a little bit more. And yes, tomorrow we can have volatility again. FOMC meetings, always present some disappointment somewhere. But the point is, once we get up to the underside of that trend line, also that indicator I've cherry picked, obviously. But the point is, that's resistance. So my recommendation to clients has been, wait before you get, really, in trouble here, shorting tech too early. Let this run its course, because I get asked every single day. Fundamentally, there's no reason. The bank collateral damage, the counterparty risk. I could go on and on. The point is, it's still running. So it needs to stop to be safe to short. So I'm waiting for that trigger.
Your second chart is really helping us dig into one of the groups that has been arguably one of the strongest across in any sector, but certainly within technology, the semiconductor space. What does this tell us about this idea of technology maybe getting a little long in the tooth?
So semis are really also a cyclical, but they're also tech. You've seen what happened with NVIDIA in their most recent earnings call, AI, like, 300 times.
Yep.
So artificial intelligence or whatever the de jour speculative asset chase is, they have done a great job of capitalizing on it. So the point is, semis are tech, but they are also a cyclical trade. So they kind of got the best of both worlds here, and they have not rolled over with, let's say, look at it. You can see, right? So we rolled over. We had a beautiful, see the H? Okay. So we rolled over, but then we bounced violently. And that was the most frustrating part also for me, because I'm like, Taiwan, I mean, I could go through earnings compression. Forget it, a higher rate regime. Why is this happening? So this chart gets me out of trouble, gets me out of my own way. So basically, I'm waiting for this to form that shoulder and rollover as a higher conviction short. Until then, it's not safe. So I have very specific, and this is on a monthly, but the point is, it's got to turn before it's safe to short.
I've seen what happens when you put the S in the question mark. That usually means we remove the question mark at some point. So we'll see if that follows your successful call before. Now, finally, we have the NASDAQ, and we're looking at high yield spreads, which we've talked about, looking at the bond markets as a leading indicator of sorts. Talk us through this one. What does that tell you about the market conditions here?
So this to me is very important, and I only have shown this to clients, so this is kind of a special thing. But since you are responsible for getting this high yield credit spread into StockCharts, which I can now demonstrate, I will share with you my concerns. I still see volatility through April, May, June timeframe. I still see the potential of a third leg down in tech of size, similar to July 2001, similar to November of 2008. This ain't done yet. So we actually have come to a point in NASDAQ where we have this 50 and 200 day, death cross, if you will, and you can see exactly where it has crossed over before and why in November, actually, when I did my client 2023 predictions, I said, I know that we're going to get bounces and strong ones, but I am still a big tech bear and bond bear. I see another major leg down, similar to summer 2001. The market doesn't see it yet. And then we have the bank runs and credit spreads. If you show on that fourth chart, you'll be able to really show the granularity of this high yield. Okay, this is, I don't have the lovely annotations on there, but if you could draw that, it's breaking out. Yeah. So this is a chart where we had this back in COVID crash, pre-COVID crash, and it is starting to break above a trend line from the summer of 2022. So I see a credit risk timing very well with this inflection point in the NASDAQ, which I think is risk off, and it will rear its ugly head, I think, in the next month or two.
Samantha, you've dropped some awesome long-term charts on us. Can you talk to us just a little bit here, given that it is Fed week, and tomorrow, of course, we have the Fed meeting. Putting on your trader hat for a minute, which I know you wear often, how do you approach a day like tomorrow? Do you generally approach it as a sit on your hands, don't get in the way type of thing, don't fight the Fed? Or do you feel there's an opportunity to have a directional bet going into a day like this? What's your general approach for it?
Well, first, general approach, because I have three very defined time frames. Chase, again, I run a live trading room, so we're looking at anything that's moving intraday over 5 days. Swing, which was several weeks that kind of go with a theme. I love trading gold in correlation to the dollar yen and bonds and timing all of that, but they typically last for a few weeks. And then, of course, trends, which are multi-month. With trends, there's nothing to really change. But this tomorrow meeting is important because even though it's priced in 25 basis points, and they really should, if you will, for confidence sake, follow through with that because they have not intonated any change to that expectation. And the Fed is not in the business of making big surprises that would upset the apple cart. So they likely will do a final hike. And then I believe they're going to go for the pause in their May meeting, or even intonate in April. Again, they have blackout right before, but they have their ways to communicate, right? Wall Street Journal, Fed Whisperer, Fed heads getting up. So the point is they will start, I believe, to indicate a pivot, because the financial stability still trumps what's going on with inflation. We have decelerated month over month since the high of 9.1% in CPI down to 6%. I actually see a deflation impulse coming, both in yields and assets. So I think that they're going to stick to the 25 basis points, but they're going to intonate a pause, and markets react negatively to a pivot. So it's basically my advice to clients when we got this intervention on Sunday, right after Silicon Valley Bank went belly up, and the Fed came in and made their announcement. I said, buy the rumor of a pivot, sell the news of a pivot. We are still in the buy phase. So the first intonation of a pause or pivot, market is going to need to unwind that move.
There is so much great expertise and insights there to unpack. Samantha, listen, it's such a pleasure to have you on. Thanks for coming on in a busy week and sharing some long-term charts with us. Be well and stay safe, and we'll talk to you again soon, all right?
Thank you so much.
That's Samantha LaDuc. Samantha's the founder of LaDuc Trading. Again, just what a brilliant illustration of long-term and connecting those multiple time frames. I love how Samantha, who runs a trading room every day, is bringing monthly charts, thinking about how she called the trends, right? The currents, swimming with the currents or against the current. If you're a short-term trader, make sure that you understand those relationships. So much importance there to some of those comments. Great take there by Samantha LaDuc. We need to close out our show, folks, and go right to the 3 in 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. We have to start with the bank ETF. Again, I'm interested when a market becomes overbought or oversold. Again, while it's not necessarily my most perfect trading signal, it does tell you a lot about the characteristics, about the conditions of the market and opportunities for counter trend moves. When something like the KBE has become overbought, you can see where even if the longer term trend has been up, we've seen a counter trend move to the downside. You're seeing the opposite here in December of last year, in June, in November the previous year. These oversold conditions, when they come out of that oversold region, at the very least mean a counter trend move to the upside. There could be more upside to be had before for banks and regional banks before this little phase is all said and done. Chart number 2, let's talk about big technology. Let's talk about big consumer. And here we're going to talk about communication services. Alphabet, ticker GOOG, also GOOGL is used as well. You can see how it's above its 200-day moving average. The reason why I wanted to highlight this chart is because the last time we broke above the 200-day moving average was here in early February. That was kind of it for the rally off of the January low. You'll note other times we rallied above the 200-day moving average. That was kind of the end of that move, and that's been the story really since the beginning of 2022. Is this time different? Getting above the 200-day, following through, certainly important. I would argue getting above those February highs, probably the most important confirmation, just to recognize that buyers are willing not just to push it to resistance, but through resistance. Our third chart in the 3 in 3 is the energy sector. Just like the bank ETF, the regional bank ETFs oversold, coming out of that oversold region. We talk about breadth conditions like the bullish percent index, which had been negative, turning back above that 30 level. That a lot of times can be an important signal. Here we're looking at the XLE, the energy sector, oversold over the last week. Coming out of that, every time here in the last 2 years, when we've gone below the 200-day and become oversold, we've ripped right back to the upside, up 3.5% today. Is there more to be had? Let's keep an eye on that chart going forward. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close. Special thank you to Samantha LaDuc of LaDuc Trading, sharing some thoughts into Fed Week. All of our previous interviews can be found for free at StockChartsTV.com. For Stock Charts in Redmond, Washington, I'm Dave Keller. Have a great night. We'll see you again soon. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.